Tim, now let's get into your high conviction picks.
Sure.
Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first pro pick is Killam Apartment REIT. Talk to me about why you like this one.
Yeah, so we like apartments in general, okay? You've got a huge supply-demand imbalance. And so as a result, you've seen huge mark-to-market growth in terms of when leases expire, the new rents have generally been higher. On top of that, what we like in terms of Killam, good balance sheet, sustainable payout, but also the market focus is in areas like Atlantic Canada, where you haven't seen the rocket ship growth in home prices and rents, which also means that you're probably not going to see a huge pullback if we do tip over into recession. And then we like the fact that they are dominant in Atlantic Canada, right? North of 10% market share in the big 4 or 5 markets out there. And then on top of that, they also have this manufactured home community business. Anecdotally, people like to call them trailer parks, but professionally, we call them manufactured home communities. That is a business that is almost recession proof. And the reason why is that most people who live in a manufactured home community are retired. So they have very little risk of losing their job and therefore their income to service their rent. Their rents are a fraction of apartment rents, like usually 10 or 12% of apartment rents. So when you talk about adding a 5 or 10% to their rent, you're talking about 10 to 15 bucks a month, as opposed to 200 or 300. So it's a much more sustainable defensive business model that is added to the Killam apartment portfolio.
I think it's interesting when we talk about the exposure. You said people don't live in a national house. They live in a place. And the concentration in Atlantic Canada, is that an advantage right now? Because we are hearing a different story when it comes to rent in maybe a market like Ontario, where they're less exposed.
Yeah, and so Killam does have exposure to Ontario. They do have some exposure to Western Canada, and they do even have some exposure to development. But it's much less than some of the others, more Ontario or Alberta-focused REITs like Cap REIT or InterRent or Boardwalk. And so when I look from a geographic standpoint to the defensiveness of their markets, we do like the focus on Atlantic Canada for that reason. All of them have got, the same exceptional access to leverage. They've all got sustainable payout ratios. They've all got sort of sustainable leverage ratios. So it really comes down to, we like the defensiveness of Atlantic Canada. We like the defensiveness of the manufactured home community portfolio.
How much upside do you think?
I think most of the apartment names offer 20 to 25, maybe 30% upside, but then you have to start risk adjusting, right?
And that's a decent dividend yield, 4%.
Yeah, but again, remember, it's very tax efficient. So you'd probably have to find, bonds yielding 9% or stocks yielding 8% to match the after-tax yield from a 4% REIT yield.
Your second one is Chartwell Retirement Residences, and this, what a home run! It's trading near an all-time high, which I guess begs the question: is like, how much higher can it go, and what do you see as the catalyst from here?
Right. So it's not cheap. It's actually trading at NAV or even possibly a small premium to NAV. What we like about Chartwell is, again, it is a derivation of housing. And so there isn't enough seniors housing, student housing, you name it in this country. We historically have not liked seniors housing. I already gave you the numbers on net operating income margins, 60% for apartments, 30% for Chartwell in this case. The reason we like it is because after the pandemic, their occupancy fell from sort of low 90s to high 70s. So right now, what you have a situation is you have 2 levers of growth on the top line. You have occupancy recovery, and their occupancy is now recovered to the low 90s, and they're targeting 95% by the end of this year. And you have significant rent growth driven by the supply-demand imbalance. So those 2 things are what allowed Chartwell to generate, I think it's around 45% cash flow growth per unit last year, and targeting over 20% this year, probably in the mid-teens for next year. No other REIT, no other real estate sector in this country has that type of cash flow growth potential right now. So we like Chartwell now because of that sort of short-term opportunity to capture both occupancy growth and rent growth. The occupancy growth is going to taper off after it hits 95%, but we'll still be looking to high single-digit rent growth because of the supply-demand imbalance.
But is it priced in?
I would say no. I would say that you're going to see. So let's say the Chartwell's trading at NAV. If that NAV is growing at 10% a year, then we should expect a 10% total return. 10% return plus the yield. So you're into mid-teens total return versus what are you getting from other sectors or other names? So no, I wouldn't say that it's priced in.
You brought to us a U.S. name.
I did.
Your third pick, VICI. Is that how I say it?
VICI, yeah.
VICI Properties, which is it Caesars, like a landlord to Caesar's Palace?
You got it. So
okay.
VICI is what we call a triple net lease. So they don't pay any of the operating costs of the real estate. So they own the real estate. There's a fixed lease to the operator of the real estate. The operator takes on all the operating risk. So for instance, in the case of VICI, they own casinos, both in Vegas and outside of Vegas. And so MGM and Caesars and Penn Gaming, they are their tenants, and they take all the operational risk of running the casino. And so one of the interesting things about VICI is that its occupancy is always 100%, not 99, not 98, it's always 100%. And then when you look at how they've structured these transactions, they have no operating cost exposure, right? So utilities go up. That is a function of the operator who actually manages the asset, like MGM. They have to stomach that. The other thing I like is that 40% of their leases with a target of 90% have got CPI escalation. So, we just came through a time period where inflation hit almost double digits in North America. All of that would have been passed through to the operators. So VICI would have been insulated from that spike in inflation. If the trade war does kick off and push inflation up, again, VICI will benefit from that because they flow it through to the operators and collect more in rent. So we really like this name. It's truly experiential, right? Who doesn't like to go to Vegas and, gamble a little bit? But it's not just Vegas, right? Vegas is more around conventions. It's more around sort of big ticket. It's not locals gambling. Outside of Vegas, if you're in Atlantic City or Missouri or what have you, that's really locals stopping off on their way home, boys going out on a night. And so that is less susceptible to economic peaks and valleys, right? When it's just people who are gambling in their local community at their, the casino they pass on the way home, that is less economically sensitive versus something like Vegas. I mean, the pandemic is one thing, but during the financial crisis, a lot of business travel was canceled, right? A lot of conventions were canceled, conferences. So Vegas is more economically sensitive, but the structure of the leases protects VICI from that type of economic downturn.
Does the uncertainty around the U.S. economy give you pause?
Not in the case of VICI. I would be more concerned about retail names. I would be more concerned about office names, industrial names. The triple net lease REITs, and in particular VICI, I think it's a great opportunity.
Is this a core holding for you, or do you see as an opportunity here? Like, what kind of upside do you?
And I'm going to get in trouble with Ed Petoniak here. I don't know that VICI is a core holding for us, but we've owned it for a couple of years now, and we're quite happy with it.
All right. Well, maybe Ed doesn't listen to the Canadian in the Money podcast.
Who doesn't listen to Amber Kanwar's podcast?
That's true.
Come on.
That's true. Actually, we are number 5 in the podcast store under business. But Dennis, thank you so much. I really learned a lot.